always honored the promise I made to my father to consistently acquire gold or silver every 2 weeks without fail. For 33 years, I have remained steadfast in this commitment, never missing a single period, no matter the circumstances. It wasn't just a habit, it became a philosophy of wealth preservation. To me, gold and silver aren't investments in the conventional sense, they're timeless symbols of wealth. They have endured through the tumult of history, outlasting 2 world wars, the hyperinflation of Germany, the Great Depression, countless economic downturns, and even global pandemics. This resilience underscores the true nature of gold and silver. They are anchors of stability in an ever-changing world. And today, more than ever, this steadfast nature is catching the attention of those who understand the intricacies of global finance, particularly central banks. Over the past 18 months, these institutions, the most well-funded and informed traders on the planet, have bought more gold than at any time in recorded history. Their actions speak volumes about the importance they place on these metals, but to truly grasp their significance, one must delve deeper into the events of the last decade. My perspective began to shift dramatically in 2019, though the seeds were planted years earlier. In 2017, I found myself confronting a reality that was difficult to accept. The previous 6 years had seen a relentless downturn in the gold and silver markets. From their highs in 2011, $1,915 per ounce for gold and nearly $50 per ounce for silver, the prices steadily declined. By 2017, the markets had been in such a prolonged slump that I dreaded coming into the office. For the first time in my career, the majority of transactions involved selling, not buying. What was once an occasional occurrence, maybe 1 out of every 100 transactions, had become the norm, with 65% of my business focused on people liquidating their gold holdings. Disillusioned investors, frustrated by gold's failure to live up to its reputation as a safe haven, abandoned it in favor of assets like Bitcoin, which seemed to defy gravity, or equities, which continued to climb unchecked. The anti-gold sentiment was palpable, and it felt as though the metal's centuries-old reputation was being questioned by a new era of speculative fervor. But amidst this bleak landscape, something extraordinary began to unfold. In 2017, the German Bundesbank made headlines by publicly demanding the return of its gold reserves from the Federal Reserve in New York. After years of effort, the Bundesbank's determination caught my attention. Why, in a time when central banks were ostensibly divesting from gold, would one of the most prominent institutions in Europe insist on repatriating its reserves? What followed was even more surprising. Within months, other central banks across Eastern Europe, Austria, Poland, Hungary, the Czech National Bank, and the Dutch National Bank followed suit, making similar requests to retrieve their gold from storage in New York and London. These moves were not only unprecedented, but also highly publicized, signaling a significant shift in the way central banks viewed gold. By 2018, this trend had accelerated, with these same institutions collectively purchasing more gold than they had in the previous 60 years combined. It was as if the world's most informed monetary authorities were sounding an alarm, one that most market participants were too distracted to hear. In 2019, the pace of these acquisitions doubled, and the implications became even clearer. The Bank for International Settlements, BIS, often referred to as the Central Bank of Central Banks, made a groundbreaking decision. It reclassified gold as a Tier 1 reserve asset, placing it on par with U.S. dollars and treasury bonds. This was a monumental shift. For decades, gold had been relegated to Tier 3 status, where only 50% of its value was recognized on a bank's balance sheet. This classification discouraged central banks from holding gold, as it diminished their financial flexibility and incurred storage costs without generating interest. But with this reclassification, gold was elevated to the same status as the most trusted financial instruments in the world. This wasn't just a symbolic gesture. It was a signal that gold's role in the global financial system was being fundamentally reevaluated. The timing of this reclassification was no coincidence. Since 2017, central banks had been quietly but steadily increasing their gold reserves. By 2019, their buying spree had reached unprecedented levels, and the BIS's decision effectively validated their actions. It was clear that these institutions recognized gold not only as a hedge against economic uncertainty, but as a cornerstone of wealth preservation. Their actions stood in stark contrast to the prevailing narrative in the West, where gold was often dismissed as a relic of the past. Instead, these central banks were using the artificially suppressed prices in the Western markets to accumulate gold at a discount. This suppression, primarily orchestrated through the COMEX futures market, allowed them to amass significant quantities of gold without driving up prices, a strategy that was as cunning as it was effective. To understand this suppression, one must consider the mechanics of the COMEX market. A single COMEX contract represents 100 ounces of gold, and with a margin requirement of around 7,000, a trader can control nearly 200,000 worth of gold. For well-funded entities like central banks or commercial banks, this leverage is exponentially greater. With $500 million in margin, they can control $15 billion worth of gold, enabling them to influence market perceptions and price movements. This dynamic has long allowed powerful players to maintain an illusion of stability in fiat currencies by suppressing the price of gold. However, this strategy is increasingly being undermined by a growing demand for physical delivery. In recent years, the drain on physical gold and silver from exchanges like COMEX and the London Metals Exchange, LME, has reached critical levels. The LME, for example, now holds one of the lowest inventories of silver in its 140-year history. Similarly, the registered category of silver on COMEX has plummeted to near-record lows, signaling a severe supply shortage. This trend was exacerbated in 2020 when a new category of traders, labeled others in the Commitment of Traders (COT) report, began to emerge. These players, which likely include sovereign wealth funds and ultra-wealthy family offices, have been quietly draining the exchanges of their physical inventories. In that year alone, more silver was delivered than in the entire previous decade combined, while gold deliveries surpassed the official holdings of the Bank of Japan. These developments suggest that the market's ability to suppress prices is waning. Each time the price of gold or silver is artificially pushed lower, it triggers a surge in physical demand from these well-capitalized entities. This dynamic creates a feedback loop that makes suppression increasingly unsustainable. The prospect of large-scale delivery requests poses a significant risk to the stability of the paper markets, which were never designed to function as mechanisms for physical settlement. As inventories continue to dwindle, the disconnect between paper and physical markets becomes ever more apparent, bringing us closer to a tipping point. This shift has profound implications for individual investors. The most influential and well-informed players in the financial world are accumulating gold and silver as if they are essential to future stability. Their actions are not driven by short-term speculation, but by a recognition of the long-term value these metals represent. For those paying attention, the message is clear: gold and silver are not relics of the past. They are safeguards for the future. In an environment where fiat currencies are increasingly at risk of devaluation and traditional financial instruments offer diminishing returns, the case for owning physical metals becomes compelling. Moreover, the historical resilience of gold and silver adds another layer of reassurance. These metals have outlasted countless economic crises and geopolitical upheavals, serving as a reliable store of value for millennia. They are not subject to the same vulnerabilities as fiat currencies, which can be printed at will, or digital assets, which are dependent on technology and susceptible to regulatory changes. Gold and silver exist outside the confines of the modern financial system, providing a level of security that few other assets can match. In conclusion, the narrative surrounding gold and silver is undergoing a profound transformation. What was once dismissed as a relic of the past is now being recognized as a cornerstone of wealth preservation by the most informed and well-funded institutions in the world. Their actions, from unprecedented buying sprees to public demands for repatriation, speak louder than any rhetoric. For individual investors, the lesson is clear: the time to act is now. By following the lead of these influential players, one can secure a position in assets that have stood the test of time, offering stability and security in an increasingly uncertain world. Whether through consistent accumulation or strategic purchases, the path forward is clear. Gold and silver are not just commodities, they are wealth in its purest form.